Before we go into our interview today, I wanted to let everyone know we have a new sponsor for our Energy Question podcast, the U.S. Oil and Gas Association, or USOGA for short. First established in 1917, USOGA has been an effective and creative voice for the industry for more than a century now. USOGA is dedicated to educating the public, policymakers, and legislators at the federal, state, and local levels about the value of the domestic oil and natural gas industry. If you're in the industry and not currently a USOGA member, please consider joining the association as a way of helping it tell your story to the policymakers whose actions impact everything you do each and every day. You can start that process by contacting USOGA through its website, usoga.org. Thanks so much to USOGA for sponsoring the Energy Question podcast. And now on with our show. Hey, welcome to the Energy Question with David Blackman. I'm your host, David Blackman, and my special guest today is a returning guest, Andrew Dittmar, director at Enverus, one of my favorite companies and one of our former sponsors here at the Energy Question. Andrew, how you doing today?
Hey, doing great. Glad to be here talking with you.
Andrew is one of the best analysts working today on M&A activity, mergers and acquisitions in the oil and gas business, and I assume you probably work do similar analysis for other businesses as well. We're going to talk about upstream M&A activity in the second quarter, but before we get into it, Andrew, just remind our viewers what your role is at Enverus and talk about your background a little bit.
Absolutely. So I'm part of the Enverus Intelligence Research Group. So we are the research-focused arm of Enverus. We cover all of the major shale plays with an asset team that does the deep dive geological work. We have a commercial team that I'm part of that track E&P equities and my particular focus, M&A activity. And we also have an energy transition group now that's focused on some of the new energy stuff that's out there. So as you mentioned, I cover M&A for pretty much all energy. I have to adjust from saying I'm an oil and gas analyst to an energy analyst these days, but still probably spend the bulk of my time on the upstream side and one of my favorite things to talk about. So happy to be here chatting with you about that.
Yeah, man, I tell you, we had a big resurgence. Just as last time you were here was in May. You told us then, after a pretty dormant first quarter this year when we had, like $8 billion, I think it was, in upstream M&A in the U.S., you told us that you expected it would increase pretty significantly as the year went on. Second quarter, big increase, just like you said. Talk about what happened in the second quarter here in the upstream sector.
Sure. So did expect it to get back on track after kind of a quiet Q1. We were up three times Q1 activity, 24 billion over 8 billion, and about double what M&A activity was on the upstream side in Q2 22. So big jump year over year as well. It's really back to that core theme we've talked about a few times, which are these public companies that need inventory, particularly some of the smaller sized ones, looking at where they can find it, and where the best inventory you can buy right now is on the private side in the Permian Basin. So you have these companies that were sponsored by NCAP or NGP. A lot of these were put together in 2016 through 2018. So sort of the life cycle for a private equity investment tends to be, give or take, 5 years, 6 years. They're coming up at a point where they were looking to sell. They had something the public companies really wanted to buy in the form of Permian inventory. So motivated seller, motivated buyer. It's good to have those two things at the table if you're trying to do a deal.
Yeah, it is. And, in the first quarter, what was it? 6 billion of the $8 billion were focused on the Eagle Ford shale, which was kind of surprising in the first quarter because the Permian practically had no activity. So now the Permian's come roaring back and is really the focus of what happened in the second quarter. What are the factors beyond that? Is it just the attractiveness of the assets, or is there more at play there?
No, I think just attractiveness of the assets is always, for oil and gas, that's the end of the day what it's all about for us. Yeah. What quality rock are you drilling? The Eagle Ford being the focus was interesting for Q1. I think it was the focus, one, because there wasn't much Permian activity. So it wasn't that the Eagle Ford was so large, it was a larger chunk of a smaller pie. And then we do still like the Eagle Ford. There's some interesting opportunities there we can talk about here in a little bit. But on the Permian side, if you want to look at tier one inventory, and we kind of classify things that break even at less than $50 WTI as being tier one. So if you want to have that quality of inventory, there's really just not a lot of places you can buy it outside the Permian. One, there just isn't a whole lot of it outside the Permian. And then what there is of that quality threshold, and say the Eagle Ford tends to be pretty closely held by a Marathon or an EOG or a Devon, and they're not going to sell that stuff. So
Right.
if you want to really get that quality, which companies do, because that's what lets you keep capital expenses low while still meeting your production targets, having capital efficiency, and being able to fund those generous dividends and share buybacks that investors have gotten used to. You need that high quality inventory to be able to do that. A lot of the large public companies have a decade or more, so they're in good shape. Talking about like a Diamondback or a Pioneer, but these smaller companies maybe have less than 5 years of that on their books. So it's a concern to the management team. It's something the investors are watching. Their stocks tend to trade at a little bit lower of a valuation than some of the big publics because they don't have that duration on their cash flows from long-lived, high-quality inventory. So it was really the key knock, I think, on some of these stocks, and naturally that's something they want to address. So focused on buying that kind of quality threshold in the Permian.
So we do still have, and these acquisitions, as you say, they're of smaller companies. I mean, still multi-billion-dollar
Right.
acquisitions, but they're not the big independents like a Diamondback or like a Pioneer Natural Resources. In the past couple of years, we've seen buyouts of Anadarko, Noble, and some others that really were the big independent producers.
Mm-hmm.
Are these independents that are still out there, like the Pioneer and Diamondback specifically, are those companies planning to stay in the business? And just so people understand, I spent my career working for companies like Burlington Resources and El Paso EMP and Lynn Energy, who were companies that were being built to become attractive for being sold, right, to bigger companies. And so I just wonder, is that kind of business model with these large independents, has that played itself out, or should we still think of them as potential takeover targets in the future?
Yeah, that's a fantastic question. I don't know if there's much on the public side that's being built for sale. That's definitely the model on the private side.
Yeah.
I think most of these publics, at least, are messaging that they're going to be around for a long time. But we're nearing an inflection point in the market. So we had the big quarter this quarter. Q1 might have been a little quiet. We had some big quarters before that on these private equity sales. I think there's been a little over 60 billion in PE sales since the start of 21. So in terms of large strategic, and again, maybe they're just small compared to some of the big public companies, but large for private company type deals we're talking about, there's just not much of it left. We ran the numbers, I think it was in the report, that there's more than 10,000 net drilling locations left in the Permian in the hands of private companies, but most of that's being held by your BTAs, your Mewborns, your Endeavor. These are family companies out in Midland. I never say never on a sale, but when you sit down in their offices, they talk more about managing for the next generation than they do owning the companies. So
exactly, yeah.
If there's anyone I expect to be around for a long time, it's going to be these guys.
Yeah.
I don't think they're going to be available for sale anytime soon. So if you look at the kind of built for sale large private equity companies, there's a handful out there, but there's just not much left. These public companies, these smaller ones, are still going to be short inventory when this cycle of deals are done. So sort of what's next? I think corporate M&A is probably the logical thing to see. And that can go up and down sort of the value chain or the food chain for these companies. I think you could see some of the ones like Diamondback or Pioneer play a role as an acquirer for some of these smaller companies. Some of them have some pretty high quality inventory. Companies with kind of the high quality inventory would be like your Matadors and your Permian Resources that are a little more Delaware focused. Some have inventory that is still very high quality, maybe not quite that high quality, but equivalent to these private assets that have been getting high dollar per location numbers, but traded pretty attractive multiples relative to where the private deals are pricing. So that could be something they look at. And these bigger companies, even if they don't intend to sell, if the right offer comes along from an Exxon or a Chevron, it could present the best value for their shareholders. So I think we've seen some movement from both Exxon and Chevron on the corporate side, not buying a pioneer-sized company, obviously, with Chevron buying PDC and Exxon
That's
buying
pretty
Denbury.
big. That was a big buy for Chevron. What was that? 7.6 billion?
That's right.
PDC, yeah. And so that one was interesting to me too, because we talk about the Permian and the $50 threshold for tier one assets. Well, PDC is a big DJ Basin producer, and I understand Chevron had a big pre-existing position and has always been one of the big players up there in the DJ Basin. But are those really tier one drilling opportunities up there in Colorado?
Yeah, the rock in the DJ looks fantastic. Definitely sub 50, even into the low 40s in some cases. We think Chevron was able to get a pretty good deal on PDC. You're paying well less than $1 million per location, whereas inventory of that quality in the Permian would cost you significantly more than $1 million. So from a geological rock perspective, Colorado is great. The issue, as you know, and I'm sure a lot of your listeners have come across, is regulations, and politically, it's maybe a little bit dicier to be operating in Colorado versus rural West Texas. So there is some discount on DJ Basin assets that we've seen in the market where they trade cheaper than they should just based on the underlying quality.
Well, let me ask you, this is a great, I don't mean to
go ahead, no, please do.
But you just made that point, and I think it's a great one to make about the regulatory risk, right? And so yes, to this point, it's been better to be drilling out there in rural West Texas. But now we've got the dune sagebrush lizard going to be listed as an endangered species in the Permian Basin. We have the EPA making noise about holding the Permian Basin in a non-attainment position under the ozone regulations. Could we see the Permian assets suddenly start being discounted due to federal regulatory risk that hasn't been the case in the past if the Biden administration keeps moving in that direction?
Yeah, these are definitely conversations that our clients are interested in and we're having, and what are some of these new regulations going to mean for asset values going forward, particularly some of the methane monitoring changes that are
right. The methane,
coming down the pipe. So I think it's definitely an awareness in M&A. We're actually doing some research on how do assets positioning in terms of emissions intensity and methane and some of that compare with valuations to see if these higher emissions assets might be discounted because they're concerned about regulatory changes that are going to hit the values. And right now, we don't see where that's been the case, but as these changes get closer, we do expect that buyers are going to be asking about that in a data room or in a process as they go through, and in fact, that into their valuation numbers. Although compared to the size of the deals, the cost to meet these regulatory requirements really aren't going to be that bad. I mean, if you're talking about a $1.5 billion Permian acquisition, maybe under the worst case in the federal regulations, you're looking at like a $50 or $100 million, fix to get your wells up to speed to meet those requirements.
For the methane, you're talking about for the methane.
Yeah, these are I'm just kind of making numbers up here to give an idea of scale. But while $50 or $100 million sounds like an awfully big chunk to me, as well. If you're talking about capital expenditures in oil and gas, I don't know that you're going to walk away from a big Permian deal because of a potential outlet. Now, you may discount your deal value by a little bit, but it's not going to change the whole structure. So there's nowhere that has zero regulatory risk, but you still see Permian, obviously Eagle Ford, Bakken as being relatively lower risk than the DJ. And I think within Colorado, it's important to note that the regulatory framework they have in place, I think it caused a stir when it was first put there, but companies have been pretty well able to operate around it. They've done a job of permitting wells years out. I think like when PDC was bought by Chevron, they had permits through 2027, I want to say. And so the current framework, I think, hasn't been as bad as what maybe was the concerns were when it was put in place, but that doesn't mean that it can't change. Framework's only as good as a legislative session. They may bring something else. So it's been manageable so far, but definitely something companies have their eye on. Beyond just the regulatory side, the DJ is a really consolidated basin. I mean, there were four big players before that PDC deal, Chevron, Oxy on kind of the big multi-basin side, and then Civitas and PDC on the independent side. Not a lot of privates left there that you really could build a position of scale. So I don't think you're going to really get new entrants anyway. Even if you take the regulatory piece off the table, it's just not attractive to buy into a play that's already basically been consolidated. So your buyer universe was essentially those companies. And it's kind of interesting to watch the routes. Both PDC and Civitas realized that I think they needed to do something, and they went completely opposite directions. PDC said, "We're out, got a nice offer from Chevron, give our shareholders some equity there, and let it run." Civitas said, "Well, we're going to go try our luck in the new basin," and bought into both the Midland and Delaware. So I think it'll be interesting to look back a year or two from now and see how those two strategies played out, and which set of shareholders have gotten the better value.
Yeah, Civitas has always been an interesting company to me. I interviewed their CEO a few years ago for a magazine story, and he was talking then about his vision of the U.S. shale business. He's very ESG focused individual from private equity firm. And he's talking about his vision for U.S. shale being that ultimately you consolidate it all down to where you only have about a dozen big operators managing all of those shale assets as sort of a manufacturing operation, so that you're taking maximum advantage. Two things: you're taking maximum advantage of economies of scale with all the connectivity of all these assets, and then also you're maximizing the ESG focus on those assets, so that it just makes it easier to cut emissions and implement the right government's policies and all that. Civitas just moves into the Permian Basin now. Talk about the two acquisitions they did.
Yeah, so pretty much down the fairway in terms of what we talked about for M&A activity. Two private equity companies that they rolled up, both from NGP, TapRock over in the Delaware Basin, Hibernia in the Southern Midland. Both good companies, good assets. We like the TapRock deal a little bit better, both kind of in terms of where the valuation landed and the underlying quality of the asset. We think that the best of the TapRock asset is going to be the very best that Civitas has going forward. So, well, the DJ, like I said earlier, has very good rock. That tier 1 Delaware stuff is just in another league in terms of the quality. Hibernia in the Southern Midland was maybe a little bit more expensive than we've seen some deals of kind of that asset quality price. You're taking a step towards the margin of the basin there on the southern side. And the dollar per location to us looked a little bit high relative to the number of locations that we were willing to underwrite on it. There may be some additional potential there. I think one of the stories we're seeing in the Permian Basin is that there's the locations you think are there based on existing wells and proven results. And then there's the locations that no one's tried that bench in that area yet, but geologically it looks like it has a lot of potential. And there's a big uplift in Permian inventory if you start thinking about what is geologically there versus what's been proven so far. There's still a lot of potential running room. So I think some of these buyers are moving towards the margins of the basin. They're looking at assets where you have 2 or 3 proven benches, but there could be another 2 or 3 that geologically work. So example, Hibernia, it's the Wolfcamp we think works in that area. Spraberry has potential, but hasn't been fully delineated yet. So SM kind of did the same thing on a smaller scale. They went a little further north in the Midland than what we've seen most companies go up into Dawson County to look at the Dean and I think Middle Spraberry. Geologically, it looks like it has some potential, just hasn't had the wells put online there yet. So it'll be interesting to watch. And go ahead.
Yeah, I mean, and so technology really plays a role in this, right? And as technology improves, fracking techniques improve, you can turn tier 2 drilling locations into tier 1 recoveries, right? I mean, and so I think it makes sense for some of these companies to be looking, trying to push the limits of where the delineation limits of these play areas, right?
Yep, absolutely. The technological innovations probably get tougher as the years go by, just because we've gotten better and better at this. So the big learning gains you had in the early days of shale maybe aren't on the table, but companies are still experimenting. I mean, EOG has been changing some well designs in the Delaware that no one is quite sure what they're up to yet. They played it very close to their chest, but in a very EOG type story, being both innovative and quiet. But they're still working on their well design there. So technology, influences how much inventory you have, and then price is a big influence on inventory too. So we're talking about there's so much inventory at $70 oil or $80 oil, but if you burn through that inventory and there's really not another slug of global production to come online, global oil prices go up, the inventory you're going to have that makes economic sense to drill at $100 oil or $120 oil is going to be entirely different than what you have at 60 or 70s. So price can have a big influence there. And then we talked some about geological expansion and are there any other resource plays to be found, which I think we probably know where the shale plays are at this point. I don't know that there's another one to uncover. I don't know that we're going to go back and revisit, say, the Tuscaloosa Marine or one of those plays that didn't work. But the Permian is just such an amazing area. I mean, it's always got more to give. So in terms of future growth and potential resource expansion, we still like the Permian and finding benches and pushing the margins further out. We think that there's still quite a bit of potential running room left still to uncover in both the Delaware and Midland.
Yeah, I remember the early days of the Permian development. Well, early days, 10 years ago. Mm-hmm. There were entire conferences being arranged in the Midland, Odessa area just to talk about the Klein Shale and how the Klein Shale was going to be the next big oil and gas play out there in the Permian. That one, of course, they produced pretty mediocre results. But this is what differentiates the Permian from these other shale play areas, and that is the existence of half a dozen big shale formations that companies are able to explore into as time goes along. So that's a big factor in why these Permian assets are so sought after, right?
Yep, absolutely. Ultimately, there's probably not going to be a lot of surviving shale companies that don't have at least some exposure to the Permian as we talk about this consolidation. And I would agree with the Civitas CEO for what it's.
I meant to ask you about that.
There's still too many public companies out there. I think that's been a consensus in shale since the get-go almost. And a more consolidated industry makes sense from a strategic perspective. It makes sense for investors. You have lower G&A. You're better able to tackle the regulatory and environmental concerns like you mentioned. So I think we do need to see more consolidation in the industry. Those deals are just hard to put together, whereas these private companies are kind of built for sale. Like we talked about, there's not a lot of public companies that really follow that model. So you're going to have to convince a board and management team that really believe in their assets and their story that, hey, you're going to be better off handing this over to somebody else. And that presents a better value for shareholders. So just getting the right alignment in terms of everything on these public deals can be challenging. But I think we really should see more. Certainly, just these consolidation of the smaller players and even some of these bigger ones that we talked about. The big Permian names or even like multi-basin at Devon and Marathon could be interesting for one of the majors to go after. So, which kind of at the end of the day takes us maybe back more to what oil and gas looked like before shale, where you had a handful of big companies, the majors that really controlled the premium resource. And then you had some smaller privates or public companies that kind of were scrappy and got by on old legacy assets. But most of the tier one stuff is going to find its way into the hands of the big companies, and nearly all of those are going to have Permian exposure, combined with some Eagle Ford or Bakken or gas. We haven't even talked about it all yet, which is a whole other story.
No, I know. Yeah, I mean, and of course, natural gas is a big factor in the Permian Basin, really, that no one ever talks about. But the Permian's the second biggest gas producing basin in the country, right?
Much to the frustration of I think pure gas producers in the Haynesville and other areas that it's hard to make money on a commodity when someone else is willing to give it away practically for free because they're making all their money on oil.
Well, what do you see? I mean, does the potential gas recoverability in these Permian deals? I mean, obviously they have to. The acquiring companies have to analyze what that is. Does it play a big role though in determining whether or not the company is going to ultimately move forward with an attempt to buy out another company in these deals?
Yeah, no, it's going to play a role for sure. You're going to fully value what you think the production is worth, oil, gas, and NGLs. You'll have your strategy for getting that gas to market, which yet again, a hammer point, we probably oversold at this point, but larger companies, more opportunities to get that gas to market, maybe more pipeline access, just easier to piece that together than coming at it from a small scale. So a pipeline access is important for both factors, important for your economics, that you do want to get something for that gas, you want to sell it, and then important for your emissions metrics as well, that you don't want to be flaring that and high up on the flaring intensity. So that's definitely being factored in the Permian. So it's just going to be what is the well going to produce overall? What do we expect oil and gas prices to be, and what economically makes sense on these assets?
Well, it's interesting. Early this year, we had a lot of talk. There's a lot of chatter out there about the Permian being somewhat constrained from takeaway capacity, particularly related to natural gas and I guess liquids too. But I haven't seen much chatter about that recently. Is it no longer a significant concern out there?
Yeah, I haven't either. Obviously, you're always watching production versus takeaway capacity and making sure you're not going to have a differential blowout on your gas. But
Right.
it doesn't seem like that story has been as hit on as it was previously. Probably a combination there of some additional pipeline capacity going online. And then another aspect of this public consolidation of the privates is it usually leads to a drop in rigs. I think every private sale that I've seen has involved cutting rigs. 50% is kind of probably a ballpark number. So as you've consolidated some of those privates that were high growth, maybe you've taken some of that kind of ramp off the table and you're a little less concerned about running out of pipe.
Yeah, I don't obsess over the rig counts anymore, but I do read the Enverus report every week that I get over from you guys, and we had a pretty significant reduction just last week.
Right.
And I wondered if any of these any of these deals, this increased M&A activity has had an impact on the fact that the rig count, which had actually risen for a couple of weeks in early July, as the second half budget began to kick in, suddenly, now it's going back in the opposite direction. We're down 20% for the year. Is Enverus anticipating continued rig count declines for the rest of the year? I know that's not necessarily your area.
I couldn't tell you exactly.
Okay.
But you're broadly aware of where it's at, but not week to week, following it back closely.
Well, one other thing I want to ask you about, and I know it's not upstream, but the other really significant acquisition you mentioned earlier was the Exxon Mobil acquisition of Denbury. And, do you analyze that kind of transaction in the work you do? I just wonder what your thoughts are about that one.
Yeah, absolutely. Falls well within our wheelhouse, both on the legacy side. Denbury still has production and is a upstream producer. But the real bulk of the value here, we think, is in that CCUS business and that pipeline asset that they have, or assets. So something we ran the numbers on. Not a surprising deal at all. Denbury obviously went through a reorganization a bit back. Post that, had launched a strategic alternatives process to put themselves up for sale. And Exxon was really the natural buyer there, given their focus not only on carbon capture, but specifically Gulf Coast carbon capture, which is where the main pipe for Denbury runs. So it's sort of expected that Exxon would look to make a deal there. Denbury traded at a pretty good premium, around 7 times EBITDA, versus these pure oil and gas producers of a similar scale trading at more like 3 to 4 times. So that CCUS business was definitely receiving a higher multiple. Probably some premium baked in because it was so well telegraphed that they were looking to sell, and that Exxon was the likely buyer. So when the deal actually announced, it was a 2% premium on the prior day close, which you could look at as, oh, that's a disappointing premium. You didn't get anything. But I have a feeling that acquisition premium had already kind of been baked into the stock. And so this was a deal that everyone expected to have happen. And, we think it makes strategic sense for Exxon. When you back out the numbers, again, most of the values on that CCUS business, and kind of giving them still some credit for their upstream assets. We think they got the pipeline cheaper than it would cost to build. Plus, trying to recreate that in this regulatory environment is going to be a long, drawn out, 10-year process. So you have it today as opposed to a decade from now. So we like the Gulf Coast. I mean, we think is the most promising area for CCUS development. Great combination of emitters in the form of all the petrochemical industry that's there. Pipeline capacity and sequestration, just the quality of the rock for putting carbon away. So like the deal for Exxon being able to grow that CCUS business to kind of supercharge it. I don't know if it's going to kick off a trend of these type of deals. There's just not a lot else out there like Denbury that you would go buy. That's kind of a typical follow-up question. But I mean, there's CRC in California has looked at doing some carbon sequestration. And I think has a JV on the table with Brookfield to develop that business a little bit better. But California is kind of a rough regulatory spot to get into.
It sure is.
Not just oil and gas, but so I'm not sure that that's where the majors are going to focus their attention. And then Talos has done some very early stage looks at building a CCUS business. But I don't think relative to the size of Talos, it's progressed far enough where you think of Talos as really being a CCUS company. They're a Gulf of Mexico producer that's exploring this business line. So on the corporate side, don't see a lot of other acquisition opportunities out there. There's not a lot on the private, just the nature of some of these energy transition technologies like CCUS. It's so engineering intensive, so capital intensive that I think a lot of the development is going to be organic from the majors versus kind of the shale model of private companies doing the work and then looking to sell down the road.
Well, that brings me to my next question. It has to do with capital. Warren Buffett was fascinated last week about his comments that he's still looking to take an even larger position in certain U.S. shale companies. Chevron was one of the companies mentioned. Oxy, obviously, he's had a big position in ConocoPhillips, you know, and on and on. I wonder if the capital, if Enverus and you think that the industry is going to be able to maintain access to the capital needed to continue executing these kinds of deals going forward, to continue consolidating the U.S. shale space, because we know that there's all these firms that are really focused on denying capital to the industry. So I think that's a legitimate question going forward, isn't it?
Yeah, it's certainly something that companies are going to monitor. You know, from our perspective right now, we don't think capital availability is an issue in the industry, that oil and gas companies are really being evaluated like they always have been. Is it a good economic investment? Now, some of the regulatory changes are certainly going to factor into that. If there's a regulatory shift that changes the economics of the investment, you need to be thinking about that as you make a capital allocation decision. But it is the fundamental numbers. Are these companies a good value proposition or not, is how investors are looking at it. If anything, we probably reached, at least for the near term, you know, kind of peak ESG or capital availability concerns in 2020 and 2021. And, you know, you had the, Ladder One proposals with Exxon and a bit more noise there. So it does seem like overall that's less of a concern than it was maybe a couple of years ago. Things tend to be, you know, flowing fairly smoothly at this point. You know, the one area maybe that has been a little bit more challenging are some of the private equity guys going out and raising money. But there's so many different factors at play there. It's hard to pinpoint and say it's an ESG or a broader oil and gas opposition concern. It's sort of, I think, more maybe a piece of that, but also you've had mixed results on the private equity side. Some in the Permian have done fantastically well. You've had some investments in other plays that haven't panned out quite as great. So they're looking at how have these investments actually performed. I'd love to have the numbers on what is the average return on a private equity investment over the lifespan of shale, but I'd have to get a lot of private equity firms to hand over the family jewels.
Yeah, they may not want to share those numbers in some cases.
So would you have been better off putting $1 to work in private equity or public companies in you know, 2014 at the bottom of the price declines? Would be a pretty fascinating analysis.
Sure would.
And then there's just a lot less opportunity for the private guys to go out, even when they have money. You mentioned that plays are relatively consolidated. There's more benches to find in the Permian, but that land, unless it's depth segregated, is already controlled by someone. There's not new resource plays like the Delaware Basin in 2016 to go out and sort of delineate and flip. So there's opportunities there. I mean, private guys seem to like going back to some of these more mature plays like the Eagle Ford, Western Eagle Ford in particular. You know, seen some movement, private investments like in the Williston and some of the Rocky Mountain plays. But I don't think you need the big chunk of capital on the private side that you had in the early days of shale, when it was more of an emerging technology, kind of trial and error, and you had more opportunities to hit some real home runs there on the private side.
Well, I got to say, from a selfish perspective, I'm a lot more interested in the Eastern Eagle Ford because I got a little family farm sitting on top of it. But it's dry gas and it's 13,000 feet deep, and I just don't think I'm ever going to get a lease on that stuff. So.
Yeah, there's some interesting. Dry gas at 13,000 feet. I'm not quite sure what to say, but never say never. There have been some deep gas wells drilled by Comstock over Eastern Eagle Ford, Western Haynesville, however you want to classify that region, and definitely, some interesting portions on the Eastern Eagle Ford too. I think when I say Western Eagle Ford, just it's maybe more where more of the assets were for sale recently. So, but one of the big deals in Q1 was Wildfire buying Chesapeake's Eastern Eagle Ford assets. So that's the old, at least part of the old Wild Horse team. Now has even a bigger position. They did at Wild Horse. They have all their old assets plus Hawkwood, who is kind of the other major player in that area. Magnolia is on the public side, still has their Austin Chalk and Eagle Ford inventories. So they haven't had
Austin Chalk, man, that resource has just been one of the most amazing resources in the history of the industry. Frankly, it's had like 4 rebirths in the last 40 years. It's amazing. So I'm going to give you a chance as we close out here to be right one more time. What's your forecast for the rest of the year on M&A?
Yeah, I think near term is a little bit more of the same. Get a few more of these big private equity exits in the Permian. There's a little bit more running room left on that story, but pretty quickly after those are off the table, there's just not going to be a lot of those deals left to find. So I think companies really do start considering corporate M&A seriously, and we get 1 or 2 potential corporate deals in there. I think gas starts to get interesting to people towards the end of the year. I don't know if we have to wait till the beginning of 24 to see those deals or not, but really well telegraphed story that crappy gas prices are going to get righted eventually by US LNG. I think buyers are going to want to play assets ahead of that LNG ramp that we think is going to take place in 25. So maybe end of 23 as Permian deals kind of fall off because there's not as much left to buy. Maybe some of these Haynesville and Appalachia deals start to step in to take their place and keep us busy. All
right, man. I'm gonna hold you to your word. We'll talk to you again in 3 months, and we'll see where we went in the third quarter.
All righty, it'll make for an interesting intro. So,
all right, man. Thank you so much for being with us today. I really appreciate it.
Yeah, thank you for hosting. Always great chatting with you.
And thank you to our extraordinary producer, Eric Perrell, to the host of our show, the Sandstone Group, and Stu Turley. Appreciate you guys. And of course, our sponsor, the U.S. Oil and Gas Association. Really appreciate y'all for doing this. And that's all for today. We'll see you next time.